Yeah, very good afternoon and welcome to this session. It's essentially disruptions in the last mile. As you have seen that it's a very well crafted panel. We have a banker and three of them actually they trade between a very thin line between an NBFC and Fintech. So between them, 1, 2, 3, 4, they actually can give us a 360-degree view of what's happening in the financial sector and the disruptions part. And last mile disruption, so as we discussed, I'll speak the list, all yours, just introducing the subject. We have been talking about how we are reaching out, I mean, multiple ways of saying this, last mile, or financial inclusion. So as we speak, 56.62 crore, 566 million are the customers of PMJDY. So that's the world's largest ever financial inclusion drive. More than half of them are women. That's one part of it. Second is, the World Bank's Global Findex 2025. The latest one says that 89% of Indian adults now own a financial account. So these are all very happy stories, good stories, how we are actually reaching out to the last mile. And also, we can't forget in the traditional, the SHG bank linkage. It's a powerhouse for connecting, and about 180 million or 18 crore households now. This is part of the SHG movement, and overall money they have taken through this is 2.6 trillion lakh crore. 2.59 lakh crore. So this is the background. We have been doing a lot of work in connecting the last mile, reaching out to people in the hinterland and the have-nots and the so-called bottom of the pyramid. But more needs to be done, and I'm sure technology and AI play a very critical role. This is a global tech summit, so without tech we can't, that's the main theme of it. Here I end, and probably I'll start with Ratan. So typically when we see that this all onus is on the NBFCs and fintechs, not too many banks are, they are in that scenario. Of course, Bandhan is an exception that through that last mile thing. Tell us what all you are doing, not a Bandhan as such, but in that field, and how the use of technology and AI changing things, disrupting things.
Thank you, Tamal. Very good morning to all of you. Am I audible at the last line? Okay. Yeah. So you know what, this GFF 3 days, there will be multiple sessions going on, and if you start putting all the words being spoken, and if you create a word cloud, I'm sure AI will be hands down winner. And we are also going to talk about AI. So look, the point is that the financial inclusion, and the topic is last mile disruption for last mile credit. I think the problem of access has been solved so far. With PMJDY having 56 crores of accounts, people have come out of their keeping money below their pillows to the banking, formal banking. I think that problem has been solved. But I think the next phase of disruption has to be essentially about impact. How to really create genuine impact of sustainable livelihood, financial resilience, and true economic upliftment of that community. And I will give a very small anecdote of what we go through every single day. We have got almost 1 crore customers. All of them are women. All of them are entrepreneurs in their own rights. Each of them employ 3 to 20. Many of them even employ more than that employees. So they make enormous amount of impact on the ground. Last year, we invited one girl for one of our celebration of New Year celebration. Sneha Bhattacharya, she is in Z Saregama top 10. She came on stage and said, I am standing here because of Bandhan Bank. Her parents could not afford education for her. They borrowed 8,000 rupee loan from Bandhan Bank, got her educated, and today she stands, that day she's been standing there, and she's really doing a lot of good, great work. And that's what is the true impact that you can keep. Now, the question that Tamal asked about why the big banks cannot enter into the space and why Bandhan Bank is into the space. The truth is that Bandhan Bank created out of this space. We were a microfinance, we became an NBFC, and then we became a bank. Therefore, for us, we understand the game pretty well. But our ability to reach, we have got 4,500 banking units. It's a fairly take and touch model. The people, product, process, and technology, all four has to go through a significant cultural transformation for a big bank to really truly enter into the space. That's not necessarily easy. It's quite expensive to many players. So that's one part of it. Second, the technology transformation is not going to be easy for a big bank to tune to this kind of segment so easily. There are, of course, example, SBI is trying something, Kotak is trying something, AU has bought a company. But I think for us to do the other side is fairly easy to that extent, because we can build a fairly competent tech stack for our universal banking. So I would say it's not very complex, but it's definitely difficult for a big bank to be able to adopt this model and really make it successful, because the cultural element, the tech element, the process element, and the regulatory compliance element can be very, very daunting.
Thanks, Ratan. So Alok and Chandan, I have between you two decide which one you pick up and all. Chandan, I think you are also from Kolkata connection, so no, not you. Then Alok, I think would be the first thing, and then okay, because we just discussed he's also from Kolkata. So there are two aspects to it in that particular segment when you talk about disruption. One is this: we have to have a different kind of products, right? Is that which caters to the Mumbai market, the HNIs, or even middle class and all. But there we have to have a different kind of products. So what are the suite of products that one can have? And the second question is for you is this: what about the risk assessment? Because most of the cases, and I'm sure Bandhan also has experienced that, you have non-collateralized loan kind of thing and all. So where you don't, even forget individuals, even for smaller entities and all, you do not have. So it's essentially balance sheet based financing. There are not balance sheet based. You don't get to even know the balance sheet despite the GST and all. So how do you actually assess the risk and make sure the credit quality is intact? Well, doing a great job in that segment, but at the same time you have to be profitable. No, it can't be a charity. So you pick up one and you pick up one. Alok, you first.
Thank you, Tamal. So I think
or combine the two. Both are
yeah, sure. So we are purely into MSME lending, so I'm going to kind of restrict my comments to the segment that we understand well. And I think this is generally known that the key challenge in delivering any product to MSMEs has been the degree of fragmentation that exists in that sector, right? Every MSME looks different. So unlike consumer products, it's hard to kind of factor them down to saying, hey, this is what my product looks like, or this is what my risk criteria looks like, right? Every segment has a different solve. And I think that is really where the disruptive power of technology comes into the MSME lending business, that you can now, super personalize, whether you're talking about the product parameters or you're talking about the risk assessment. That degree of customization is very hard to achieve in a human-based process, because essentially there you're trying to create one policy print of saying, hey, this is my policy as per which I lend, or one product construct, that then can be delivered efficiently through an operational process. So let me take a couple of examples, right? On the product side, we support working capital loans, we support supply chain finance, we support term loans. But within a term loan, we don't have a standard form factor for what we offer to a particular customer, right? On a per customer basis, we assess what's the volatility level in that business. And depending on that, we will offer the tenure to the customer, which may vary month to month, right? So it might be someone might get a 15-month loan, someone might get an 18-month loan. And this is driven out of the analysis that we are doing on their footprint to basically make sure that the product fits the customer needs, but at the same time, it follows the risk parameters that we have set out for those. Similarly, we do cash flow based lending, where we can have a granular understanding of both the inbound and outbound cash flows of the merchant, and hence be able to create products that otherwise would not be available to them basis their credit score, right? So I think it is really this fragmentation in the MSME base where the core role of technology comes in to drive inclusion. And in some sense, that is the delta between how larger financial institutions have approached this market, which has left an inclusion gap, and why technology-based approach starts to address that.
Yep.
Thank you, Tamal. Good afternoon, everyone. So I represent Muthoot Papachan Group or Muthoot FinCorp Limited. In fact, it is apt that I'm part of this panel because the very purpose of Muthoot Papachan Group or Muthoot FinCorp Limited has been to drive financial inclusion. We are doing it for more than 138 years. In fact, 46% of our customer base is new to credit. But more important,
138 years you are there.
that's right, sir. Not very old. We are kind of young enough.
No, but I didn't know that. Anybody knows that Muthoot is 138-year-old? Oh God. Okay, sorry. I don't know. Oh, yeah, please.
So, now coming to your specific question, sir, that the risk piece
and
actually.
products and risk. How do you customize
Yeah.
the products there and the risk assessment?
There I would actually
Because
specifically
it's
talk
cash
about.
flow based, and
That's right.
often the bankers talk about we are not even equipped
Exactly.
to assess the cash flow based financing.
Yeah, absolutely, sir. So, see, what is happening actually is and a lot of credit goes to our government, I would say regulator, that for last few years, there is something called JAM Trinity which is in the work, which is, we all know, right, Chandan, Aadhaar and mobile. But that was aptly came along with UPI. So it's JAM plus UPI started giving digital identification of the transaction these MSMEs are having, right? And we are talking about pan shops, we are talking about grocers, right, which do 10 rupee, 50 rupee, 100 rupee, right? And as Tamalda very rightly said, this is actually giving a real data to us, which is a daily cash flow. So gone are the days where we underwrited a specific MSME basis their credit behavior. How about underwriting them basis their cash flows and a real-time cash flows? And interestingly, we run a product, sir, which is a equal daily installment product, wherein we give loan up to, say, suppose 5 lakh rupees or 7 lakh rupees to a grocer and collect the money back like 100 rupees, 300 rupees every day. And thanks to the JAM and the UPI combination, we have been able to successfully underwrite these customers and collect the money also with very less effort.
And collection is through technology.
Through technology.
The cost is not involved. Somebody going and picking up.
93% of our money comes daily with the use of technology.
Yeah, sure. Well, Nishchay, this is about, we are talking about disruption in the credit market, but Nishchay represents a very different segment. He is actually in the savings segment, right? So tell us there, how does the technology play a role and what kind of disruptions you're seeing?
Hey, thanks everyone. See, we started JAR during COVID. The whole idea was we recognized how fragile personal finance is during COVID. By third month of lockdown, we figured out people had no savings, people didn't have access to credit, and people were not insured. That led to starting JAR, and we thought with use of technology, you can take the financial services to the nook and corner of the country. And because of technology, you can customize and deliver in such a manner where it becomes relevant for everyone. We offer the platform in 10 plus languages. We developed language in such a way that it simplifies. One of the major challenges with financial services is how pretentious and filled with jargons it is. Like insurance premium, like where does this word premium come from? How often a common man uses the word premium and what is it associated with it? It has got nothing to do with insurance industry, like it's a premium water bottle or premium car. It's not premium insurance, like, oh, is it an insurance which is premium? So the language has to do a lot of work. And other than that, we also figured out that most of the financial services is designed by people who take monthly salary. For whatsoever reason, in their mind, the rest of the world gets paid on 1st of every month. And they design every product around 1st of every month. And you just have to think, think of the diversity of people in this country, right? Hardly 20% are salaried. More than 80% of people are self-employed, skilled, semi-skilled, unskilled, traders, doctors, lawyers, all sorts of people. There is no product designed for every use case. The only other use case we think is, let's make it daily. That's the easiest thing that we also took. We also started with simple daily savings product, but we use AI extensively to deliver a customized journey for each one of the consumers. We are able to score the people in terms of what is the propensity of a consumer to save for a particular day. Should I nudge him? Should I not nudge him? Should I take specific attributes of a consumer. For example, when a user starts saving on the platform, we ask him, what are you saving this for? He might say, I'm saving for family emergencies. So when we send him a push notification, we don't use that information anywhere else in the app, but in small communications, you can use this. That's where AI comes into. Like we can say, hey, family man, today's saving goals are met. Or you could be, you may say like, I'm saving for my sister's wedding. We can say, hey, big brother. The use of technology and delivering customized messaging and nurturing the consumer is where AI plays a big role.
And that messaging in different languages.
In different languages. Okay. We have deeply integrated 11 Labs, Servam, and all of those things, and built custom layer of dictionary, which colloquially, we don't speak it like a newsreader. We speak like a common man, which helps across India. We have users across 14,000 pin codes today. And we help a couple of million people save every day on the platform. And we are able to do that only because we are tech first. We embrace the diversity in the country. We embrace the language. We don't judge. We only observe and we try to serve.
Thanks. Very, very, very interesting. So tell each of you, I mean, what do we want to say? That there have been, like all of us are aware of that entity called account aggregators. And there's a feeling that, yes, this is the right entity. It's democratizing the credit market. I mean, do you agree with this, or you are probably you are not, you may not have any idea. I mean, you may not have any opinion because you're in the saving space. But feel free if you want to add.
Yeah, for us, the rest of you. Yeah, for us, account aggregator plays a massive role because once user gives us the access to his transaction details, we now analyze where he's spending, how he's spending, so that we can customize his savings goal. See, but the way we see is financial fitness is achieved through 3 layers. First, you need to build the habit of savings, basically meaning delaying the gratification and setting aside something that you earn today for future use. And second step is to credit, because once you start saving, if you don't have access to credit, you keep dipping into your savings. Your savings will never compound. And the behavior that you have inculcated in savings is what will help you to build a healthy relationship with credit. Because there also you need to delay the gratification. I mean, take a loan today, do some business, earn some money, I can spend it all without paying back. I need to build that habit of delayed gratification.
Yeah. Thanks. Yep. Chandan?
So, sir, if I were to talk about account aggregator, I will take a step back.
Why don't you just give one line introduction, what is account aggregator, so that those who are not familiar with this.
I think this August gathering, I'm sure everybody knows about account aggregator. I would say, and linking it back to the topic of the discussion, which is the last mile disruption. The reason why credit was not taken to the last mile few quarters back was, one was the operating cost of taking the credit to the last mile. And second, the risk involved of not underwriting properly, right? Because we needed tamper-proof data which we can trust, right? Account aggregator is actually helping us to do that. One, data which is tamper-proof, which you can rely on. Second, giving you it at a fractional cost. Combination of these two allows us to do underwriting where as a lender you can be a bit more assured that you're lending to the right person, lesser cost, and then if you start monetizing on top of it, you can give back to the borrower, right? And that is a kind of flywheel which we need, and account aggregator is very well placed to do that.
Alok?
No, I agree with Chandan. I think that has been a key public innovation which has powered credit growth in the country. We do believe that there are elements of account aggregator that need to develop faster. Coverage of current accounts of non-sole prop entities. I think those are areas where the account aggregator framework needs to develop faster. But we already use account aggregator in all of our credit workflows. And a while back, it started to then cross over what we were getting through net banking, bank statements, and so on. So that crossover point has happened. So certainly, within the DPI stack, as far as credit is concerned, this has been a key innovation and very helpful to enhance inclusion.
Ratan, from a banker's point of view, how do you see that?
I think I'll complement to what they said. Of course, account aggregator is giving you a lot of insight about consent-based data. But I think that alone is not helpful enough unless you've got the bureau score coming in from another side. you have your field visit done, because that's one of the important elements of risk assessment for this segment of customers. Also, predictive understanding, because I have seen for my customers, whenever they don't come for a group meeting, one meeting, there's a red flag. They don't come for the second meeting, it's serious red flag, and therefore we've got to do something about it. So some of these are important elements of risk assessment, apart from the account aggregator, bureau, field assessment, HHI, and predictive analytics.
Okay, thanks. When you are talking about account aggregator, we are actually talking about the accessibility of the data, so that you get to know that. So on that, on the other side, I'm asking you, each of you can tell us, give us something about the role of credit bureaus. Now, one of the reasons why the unsecured lending at this point of time, particularly in the microfinance space, there's a lot of issues there, is a over-leveraging of the customers. Now, there could be entities who have deliberately to push up their balance sheet growth, etc. They did encourage over-leveraging. And at the same time, many of them said that they are not even aware of that. Some borrowers are actually over-leveraged, but they are not caught by the credit bureau. For instance, I have taken 7 loans, but I have taken it from one NBFC, or so 2 NBFCs and 1 bank. They have been captured, but some of the Fintechs, no offense intended to you guys and all, there is not yet captured. Credit bureau do not capture, and that is creating a mess. So first of all, do you see there's a genuine concern on that? If there's a concern, how do you address? Because when you are disruption in the last mile you are talking about, that's a very critical element. Unless everybody is covered by the credit bureau, how would the lenders know? And then you are creating the problem.
Yeah,
Alok,
so I think there are 2 pieces of this, right? So one is coverage.
After this, we are just about halfway through, 22 minutes. We have few questions we can take from the thing, and then we'll come back. Okay, just get the microphone ready. If anybody has any questions, just introduce yourself, make it very short, no commentary, only question. But after this, yeah.
So I think there are a couple of different ways in which credit bureau data is adequate or inadequate. I think the element of fintechs not reporting to credit bureaus is largely a solved problem.
Largely?
A solved problem.
But so you agree that this has not been captured by the credit bureaus?
That is now being captured. Adequately.
Now being captured.
Yes,
okay.
Because behind every fintech, ultimately the lender of record is a regulated entity, and they are obliged to report these loans to the credit bureau. Whatever happens outside of the regulated domain obviously is not an activity that gets captured.
I have come across many entities where the fintechs are encouraging me to take the loan, and I said that you will get into the bureau, you will get into your rating, etc. after a few cycles.
No, so we are not seeing that as a dominant issue. I think one of the places where we do see a gap is the timeliness of reporting, right? So broadly speaking, if I am taking a credit decision on a customer today and I pulled their bureau report today, I am blind to what happened in the last 60 days, right? Because even if they've taken a loan in the last 60 days, that reporting cycle may not have started yet. And in our customer base, we would find about 10 to 15% of our customers who have taken a loan in that window. So our decision was blind to that loan having been taken. There is a proposal within RBI, which was part of the UK Sena Committee report in 2018, which was to come up with a real-time credit reporting, PCR, public credit registry, which would capture loans in real time.
No, but RBI has fine-tuned it recently.
So it's gone from 1 month to 15 days.
Yes.
That is still going through implementation.
Yep.
But I think where we need to be able to get to is that as soon as a trade line is opened, that is reported to the bureau so that any other person who's looking at making a loan has access to real-time historical information. So I think that is where we need to. So I think the time gap is more significant here in our experience compared to the coverage gap by entity.
Yeah, Ratan.
So, 2 parts. Of course, time gap is getting solved. Most of the banks are actually fairly organized in this space. But yes, fintech players have not been. I think that problem is getting solved more and more as quickly as possible. But there are issues with regards to gaming that bureau score. And there are people who actually telling their borrowers saying that you take a small ticket loan, keep paying for a period of time and I'll increase your bureau score, and that can actually be a bit of a...
And I have come across, and
Yes.
trust you me, I'm not cooking up the story, in Kolkata in a pub. I found that four guys from university or whatever it is, they are merrily drinking beer and actually making noise, so nobody would dare to. Then I just got a little friendly, etc. Then I found out that they are financing by actually taking loan.
Yeah.
I'm not naming the entity, so it's a local entity. They give loan, and they said like, and somebody, one fellow gives little tuition, so he pays back. One fellow, his father is a lawyer, he pays back, and other two are being held by these two guys and all. I said, how do you get? What's your rating? He said, no, we can, if we are, after a few cycles, we'll be upgraded and we'll get our credit score. Then we can get into a proper financial channel.
Yeah, so that's
the
one,
hook they are using,
that's one
and
game.
they are being charged 60% interest rate.
Yeah. So that's one of the games being
That's also
played.
disruption in that segment. That's what
Yeah.
I want
It's
to...
a disruption on
the
the
other
other
side
side.
of disruption.
But, sir, on the credit bureau side, one is frequency, second is this gaming aspect, third is, I think, TransUnion, CREEF, Highmark, all of them have got different models. And sometimes people do look at the score, 750, 600, which is right. The scales are very different. So I think that understanding is, again, a bit of a question mark between the different bureaus that we have in the country. And the fourth is the data quality issues. It's very difficult to catch. You just change one of the parameters and it's almost impossible to catch that same guy. And therefore, the stack lending of 7, 10, exposure with multiple borrowers is happening. I think these are the potential risks around them.
Chandan?
I will just add to what
Please.
Alok and sir was talking about. In my view, bureau certainly is a very essential part and will remain as an essential part of lending. But I would say that in the evolved arena where the speed and the kind of product we are coming up with, bureau in itself is not sufficient. It has to be complemented by additional data. Like, for example, I talked about cash flow data. The nature of business the person is doing. Like sir talked about essence of doing field visit, understanding the very nature of the business. I would suggest, and plus the model we try and make on top of it. Like for example, the daily business which we do, we try and calculate what is the cash flow value as a compared to the daily installment the customer needs to pay, right? These intuitive understanding of the business and applying that into the risk modeling is very important to complement the bureau score.
Nishchay?
What we have seen is majority of my users are new to credit and
New to the credit bureau.
new to credit altogether. They've never taken a
And
loan.
they have been covered by the bureau?
No, not really. The challenge for us is how do we expand credit to the consumers? There are only few NBFCs who operate digitally, which lend beyond those 600, 700 PIN codes. And we are trying to bring them to the fold, and we have figured out recently that the only way to help them is to help them build a healthy relationship with credit. Start with a secured credit card with a bank where they put in an FD and slowly start building a credit history for themselves, so that credit is one of the most instrumental weapon they have in their arsenal for their own goodness of life.
Thank you. We said that we would take a few questions if anybody has. Otherwise, yeah, please. This gentleman, can he get the mic, please? Just introduce yourself and...
Myself is Arnab Chakravarti. I'm representing the Bengal Chamber of Commerce and Industry. My question to Mr. Khaitan, just now you have said that there is one part where you are talking about intuitive, learning about the portfolio of a credit and then mapping it with the risk modeling. So the intuitive part is a kind of part which is not coming directly from the technology, and the risk modeling part is coming to the technology. Are you also including the intuition of the person concerned about the person concerned is also a technology enabled?
Yeah, so
Thank you.
interestingly it is, and I'll give you a very simple anecdote. When we started giving EDI loans, we realized that we were giving loans to every possible kind of, I would say loosely, I will use the word kiranas, right? we started realizing that the default rate for a stable shop or a fixed shop was much lesser as compared to, like, for example, thelawalas. We had the data where the geolocation of the thela was moving beyond 100 meters. So we found out the technology-enabled solution where whenever the location of the thelawala is moving beyond 100 meters, means it's a mobile shop, right? We stopped giving credit to that individual. Similarly, we knew whether this guy is a vegetable shop or a flower shop or, say, suppose a fruit shop. And if it happens to be a mobile shop, we will be risk averse to that kind of segment. So we have used technology to actually identify that kind of segment. That is what I meant, actually.
Thanks, Alok. Yeah, the gentleman at the rear, yeah, please. Introduce yourself and brief question, no comment, yeah. Microphone is not working there, it seems like. Put it on, or she's rushing. Quick, madam.
Hello, can you hear me?
Yeah, please.
So this is Abhishek, and my question to basically Ratan sir and Tamal sir. So is that like major component of giving credit in, let's say, last 300 years, 400 years, apart when like CIBIL score and all these bureau scores were not existing, was social capital, how much people trust this particular person and trust, right? But when you look at the credit ecosystem and like how credit is being disbursed today, it's just looked at like the thick CIBIL file, but very less component of trust over there. And I particularly feel I do debt collection myself. We run an AI debt collection agency. I do debt collection myself. I see people crying on phones saying that I paid loan for 7 years, but one life event happened and I'm out of credit ecosystem. Okay. So how do you see using all this customer interaction data as a trust score and adding it on top of CIBIL score to basically lend to people who have thin files but good intent?
Thank you, Ratan sir. I'm not qualified to answer all, and you are not here to listen to me, to them. Yeah. So Ratan sir,
so,
quickly.
I don't quite agree with what you said.
Thank you.
Our model, as we evolved, has been deeply embedded into 3 distinct factors. Number one, it's an informal joint liability group. So they all do the similar trade of business. So they're jury maker, they are all part of this. All the women, they do together. That means they know each other pretty well. One person brings reference of another person to make it part of the group. Each group has a name. They take pride in that group name. They meet every week for a meeting wherein one of the relationship officer will go and collect that installment for that week. Before we give a credit of a particular ticket size, not only that we visit the borrower's workplace, but you also home and know the community. And that's a significant part of our credit underwriting model. Bureau comes as an additional data, and with AI today, we are getting alternate data. So those are actually enriching factors to make it more sophisticated to get right on either side. You don't want to let go a borrower who is good, but alternate data supports that, not alternate data. Without alternate data, we can't extend credit to them. On the other side, on the standalone basis, it looks to be good, but not necessarily great. So I think those calls are taken. So I don't quite agree. Most of the companies who are in the deep embedded into the microfinance sector are actually using lots of data, not just the AI model.
Thanks, Ratan. So thank you, gentlemen. Get back to us. We have how many minutes left? We have about 7 minutes left. So tell us, we spoke about credit bureau role, we have spoken about risk management, the products, we spoke about account aggregator, but the core issue is this from the regulators. What do you want the regulators, not only one regulator, to do to actually intensify the disruption in the last mile credit? Starting with you.
Yeah, so thank you. And again, I'm going to limit myself to the MSME sector.
Don't be diplomatic. Whatever you want from the.
I think most people in this room would agree that our regulator has done a fine job of controlling systemic risk. Now, having said that, I think one of the things that have not gotten highlighted is, from a regulatory standpoint, a lot of MSME infrastructure has gotten bundled with consumer infrastructure. We have not had an opportunity to think about MSME infrastructure for credit differentially from what the consumer infrastructure should be, right? So when Chandan talks about JAM and UPI, well, it's the same for consumers, it's the same for MSMEs. I think one of the key things that is a lever in MSME lending is cash flow-based lending. And some of the recent movements around digital lending have actually been counterproductive to the cause of cash flow lending. For example, being able to deduct payments from within the payment aggregation flows of an MSME, right? That is something that is not allowed today, right, by regulation. And rightly so, perhaps for the consumer use cases, but I think what we need to do is to pull apart MSME inclusion as an explicit goal of these regulations, and then do things that allow us to get more credit inclusion for MSMEs. An interesting blueprint of this actually was in the 2018 UK Sena Committee report that I referred to, including the real-time credit bureaus, cash flow-based lending, being able to landmark a banking transaction that could be payback for credit, right? So there's some very interesting ideas there, and I think that's the direction in which MSME inclusion has to go.
Chandan, you are nodding your head vigorously, so.
Because I'm impacted with one of this actually, very recently. But yeah, we had a...
What's that?
No, the deduction from the collection, the escrow actually that got stopped, but we had an alternative. But I think cash flow lending is should be seen very positively by the regulator. The good thing is they are, but there are many proactive enablement they can do. The second thing which I would actually say is that credit on UPI is one big disruption which is about to happen. It is restricted to the banks as of now. And I'm biased towards NBFC because we are an NBFC. NBFCs have done for decades a great job of enabling last mile credit. I think credit on UPI should be something which should be more democratized and given to everyone, and which we can actually take it to the last mile of this country.
Lisa, you want to add anything?
Yes. So for the limited interaction that we had,
What all you are expecting from the regulators to intensify the disruption? Any wishful thinking?
Yeah. No, the wishful thinking is from the our side rather than from the regulators. So far with the limited interactions that we had, I think we, as part of the NBA, part of the companies which are running fintechs we are doing, we need to be more vocal, and we need to go and ask for more suggestions. At the same time, take a lot of learnings, because we are the ones who are doing the last mile thing. We come across so many use cases. As he said, in the human world, there was only fixed policies, fixed set of rules that was being used. With advent of tech, being able to reach the last mile, last guy in the last village of India, we will have a lot more learnings, and there should be more proactive engagement from our side, so that we throw
Ratan,
more light to it.
1 minute just. Anything you expect from?
No, I think few things the regulators are doing
Quickly,
pretty
1
welcome.
minute, not more than
One is onboarding of account aggregators to be simplified. I think a lot of work is happening by the regulator on that side. UPI, account aggregator, ULI. ULI is already on. I think if you can fast track us collectively, that's the second piece. Third, I think as he mentioned, cash flow-based lending has to be encouraged a lot more. I think if we can get some of these things going, I think the disruption will be faster.
Thanks. We have about 3 minutes left. So one last round. Just give us one. I don't want to. No one looking for any message, anything. But one anecdote which you think that illustrate how you have your entity has is a chance for marketing yourself. Okay, how you have like Ratan, without even asking, he already did. One girl said that she could top the Saregama because of I'm not saying naming the entity, but his bank. So like he has already done it, but one more chance. Yeah, one anecdote actually illustrate the disruption in the last mile. Quickly, 30 seconds each.
We embrace language, we embrace faith, we embrace culture. I think one thing that every financial institution across the country has not embraced is the faith and culture of the land. We do that effectively. We encourage from Rakhi to, it's not just running some ad campaigns, how do you build products for them? And we have people who are saving on jar to give something nice to their sister for Rakhi. We have people who are saving on jar to give something to their mother, to their father, to their brother. We have users across 12,000 pin codes. We have users in last village in Kashmir to Andaman Nicobar.
Great, wonderful to hear that. Yeah.
So I will quote our Honorable Finance Minister a couple of years back. She said that if we were to move towards Viksit Bharat, we need to start lending to MSMEs basis their digital footprint. We actually embrace that message, and for last, I would say, few years, we have been doing cash flow-based lending, and now we have made it tech-enabled, where we have lent to more than 300,000 small businesses in this country, where we collect on a daily basis. which is actually taking the inclusion to more than 14,000 pin codes in this country, and we are going big
Thanks.
on that.
Ratan, 30 seconds.
So I'll give one more anecdote.
Just quick, 30 seconds.
So we
30
have,
seconds.
we every year in Foundation Day, we do Impact Pavilion. We invite a lot of our customers to come. Last year, we had this customer called Miss Maiti from Nodia district in West Bengal. She borrowed 10,000 rupee loan 10 years back. Today, she runs a company. She creates swings. She got a contract from Singapore government of 32 crore for a 5-year.
Wonderful. Wonderful.
She employs 400 people. 80% of them are women. That's the disruption that we do. And to sir, the government has launched Lakpati Didi of 3 crore women entrepreneurs. I think we will be one of the major impact creators in that journey.
Alok, challenge is, can you get a clap? Because he is getting clap, nobody else.
No,
Nobody else. Just hold on.
I think for what they have done, they deserve the clap. So one round of clap for him before I speak.
Quickly, 30 seconds.
Yeah, so I just want to bring the topic of this last mile inclusion a little bit to life.
30 seconds, sir. Whatever
45
you want to
seconds,
break, you break, borrow, break, whatever, but 30 seconds.
So I just want to kind of present a number. The participation rate of women in MSMEs in India is about 20%. But if you look at mainline banking and not Bandhan Bank, because the origins of Bandhan Bank are very different, the participation rate in MSME credit for women is less than 10%. Right? And a lot of this exclusion happens, not because someone is making an intelligent decision, but because they're making a biased decision. Right? We take all of our credit decisions basis the credit models and data models that we've built. For our company, we have managed to get our MSME participation, women MSME participation rate to 25%. Right? And I think that is the power of inclusion that data-driven lending can bring in. It's not in bringing in new insights only, it's also to remove the biases that exist in the human underwriting world.
Thank you. I'm not going to conclude and again giving remarks, so wasting your time. So if you are happy enough, so give a clap to all 4 of them, not Ratan alone or not Alok. Thank you. Thank you all. Thank you.
Thank you so much for our incredible panel. May I request our panel to please come ahead for a group photo? Ladies and gentlemen, a huge round of applause for our incredible panel. It has been an enlightening experience engaging in conversation with all of you. We extend our heartfelt thanks to our esteemed speakers, moderator and audience. It has been an honor to have you join us at the Global Fintech Fest 2025.